Hello and welcome back. In this video, we will be learning about financial modeling, what it is, what are the objectives, and what kind of decisions we do make via financial modeling. So let's start. In financial modeling, in the previous videos, we learned about that we want to make decisions under various categories. So in this video, we will be learning those categories and what kind of decisions we normally make. So in the pricing and costing decisions, we want to set the prices for our products. We want to calculate the standard cost, how we calculate the standard cost, how we do the pricing for our products. We do the scenario planning that, okay, if this price is, we are setting up this price and this percentage cost, how much it will affect the demand, how much it will affect the profitability of the company. If the price is set at certain level, what is the break-even point, how much money we have, how much margin we still have for negotiations. So all those kind of decisions are taking under this category that are achieved through the financial modeling. Then we have capital budgeting decisions. So we are buying new equipment, we are investing new equipment in the new businesses, we are evaluating, should we buy the equipment or should we rent the equipment. We are also evaluating in these kind of decisions, should we repair the equipment or we should buy the new one after the expiry of their warranties or their major repairs. So these kind of decisions are taken under capital budgeting decisions. Then we have also capacity planning, what kind of capacity we should buy the equipment, because the price of equipment is different on each capacities. There you want to buy a bigger equipment, you will have to incur a lot of overheads, but you have a flexibility in future to increase your business. But if you buy a smaller equipment, it will cost less, maybe less electricity, maybe less labor, maybe less space. But if you want to increase the business in future, you may have to buy another one because it may not be able to handle the capacity. So these kind of decisions we evaluate through the financial modeling. We make the projections, we evaluate what are the benefits of our decisions, what are the costs of our decisions. And then we do operational decisions, that we want to do something by ourselves or we want to outsource certain things. Do we want to commit a fixed cost or we remain with a variable cost? Like for example, in automation is a fixed cost, but then the variable costs are very little, but manual works are more on variable cost but less on the fixed cost. But then you still have to consider the decisions that if you are incurring high fixed costs, you need to have a certain break-even point, certain number of sales to recover that cost. Otherwise, you are making financial losses. For variable cost or manual works, you have a capacity crunch because you can increase your product to a certain range only, or you can the delivery time is limited. So these are all kind of decisions that we do in the operational decisions. Then we also have the operational and marketing budgets. We are making the budgets which by spending certain amount of money, what will be the profitability. And then we do have forecasting and projections. So in these kind of decisions, we are estimating our balance sheet, our profit and loss, our cash flow for a certain period of time, maybe next 3 years, next 5 years, to see how the business is going to grow, what will be the valuation of the business. And then we do the scenario managing. If the political situations are worse, are best, or the base case. So we will be looking at these a few of these three statement forecast in our financial modeling sample, so that we can understand this financial modeling in more details. So next up will be on